Cool. So firstly, again, thank you all for being here on a Saturday. It's a good sort of start to a Saturday in my books. And, you know, it's been a long time really, actually, Andrew, isn't it? I think we first spoke in, I don't know, it must have been
February or something, yeah, which is also my fault, but I've basically been a massive pain already.
Yeah, so me and Andrew were talking back in February. So I just want to open and start. Andrew, there's a good portion of attendees on here who have read near enough all your books now. We kind of sparked a bit of a thing throughout social media about picking up your book, and it opened a lot of people's eyes. And as you say, it's plain English, and it really is. It's so easy to understand, and it's opened up. There's a lot of property-based people on here and business owners, but the book really opened everyone's eyes to different avenues and actually perhaps protecting themselves a little bit more by diversifying. So on that front, it's played a huge part. So thank you on that front.
Thank you guys for all being, I mean, you know, I wouldn't have the sales numbers I've had since we launched the 3rd edition if it wasn't for people like you. So it's massively appreciated. Word of mouth is, you know, we don't do any paid advertising at all. So we kind of live and die by word of mouth.
Yeah, awesome. No, it's a brilliant book, and it's all well deserved. You know what you receive, so all well deserved. What I will do then, just jumping straight into it, just to go over. I know I put it in the email, but the question structure, because I want to maximise Andrew's time, but also want to get your questions out. And I know you're all going to have questions already written down, but please use the blue pop-up hand. However you do that, I still don't know how to do that, but use that system. And the chat. If you can use the chat, I'll read them as we go, and I can just sort of quick fire them throughout. And towards the end, I'll open up. So that's how the questions are going to run. And again, just thank you for being here, Andrew. And we all know about you. I don't think there'll be anyone on this call that doesn't know about you or hasn't checked you out in some way or another. But if I could just have the typical, Andrew, the overview of how you started, really.
Tell me about yourself, chat. Well, I'll tell you what, if it's all right with you, obviously I've got a basic idea of what this group is and what you're all about, and particularly the property side of it. But is there anything else I should know before I sort of kick off in terms of, you know, anything about it? It seems I can see from everybody's faces it's quite a young group, which is good. Although with apologies to anyone who that that isn't relevant to, but and I mean that in the best way, obviously. But yeah, because the more I know about you and about the audience, the more I can try and answer things in a way that's relevant rather than, you know, isn't too low a level and too obvious or whatever. So if there's anything you can tell me like that before I kick off, that would be helpful.
Yeah, sure. I think so. Again, it's primarily business and property based, but also diversified now into other areas, but perhaps on a medium to lower level. But it's very much a case of, I think, as much knowledge and experience as you can hand over in the period of time that we're on the call in regards to probably the questions that I'm going to run through. Will just be, you know, anything I think that comes from your way will be helpful. But that's kind of the background of most people, I'd imagine.
All right, then. Well, then I'll cringe my way through, as a typical Brit. I'll cringe my way through the telling everyone about me bit as best I can. But so I started in the city. I did an economics degree in the mid-90s. I went off to the US Congress to be an intern on the Hill, which I only mentioned because, you know, that was probably what got me from Birmingham Uni doing an economics degree to kind of a top job at a top investment bank, because that's a pretty hard, you know, if you don't go to like Oxford or Cambridge or Harvard or whatever, it's quite hard to land one of those jobs, and probably more so today than even back then. But yeah, so I ended up starting work for Swiss Bank in 1998. And basically I started, I think part of why I was able to write that is because I was quite rare in the city in that I started my career in bonds. So I was on the Eurobond desk at SBC Warburg, as it was then, which then became UBS. And then I just found it really dry and didn't really enjoy it. And I was very lucky that I was managed to move internally to equities and to smaller companies, which is a real kind of plain vanilla, basically what most people understand a stockbroker to be. You call up investors, big pension funds, hedge funds, mutual funds, insurance funds, who have hundreds of millions or billions of pounds, dollars, whatever. And your job is to basically sell the research output of, as it was, Swiss Bank. So we had 106 analysts writing research on about 900 companies in basically every city in the world, because it was Swiss Bank, obviously, but I was particularly focused on London and the rest of Europe. And that was obviously pretty amazing, you know, in my early 20s, because the team I was on floated, so IPO'd, like lastminute.com, EasyJet, Campari, Burberry, HMV, although we probably shouldn't mention that one given that it went into receivership. You know, we did Pizza Express, we did, and it was nuts because I was, you know, 25 years old flying around Europe with a sort of big bag of Campari bottles over my shoulder with the CEO of Campari handing out Campari bottles to, you know, Italian investors and French investors and German investors. And so a lot of, you know, I always say, and it's a statement of fact, not exaggeration, because I've actually made the list. In the last 20 years, I've met over 1,000 CEOs. So because the standard business model is that the company, you know, the CEO, the CFO, quite often the chairperson will come in and present to us as an equity sales force and let us know, you know, obviously, if it's a new company you've never heard of, like lastminute.com was, you know, the first day I met lastminute.com was like, what the hell is that? How are they going to make money? You know, and the rest is history, obviously. But they'll come in and meet us, explain to us what they do. And then our job is to go out and find the money, basically. And then, you know, and so that I think, had I not had that exposure, I wouldn't have been able to write the book. And also, had I not had a bond exposure, I would have been, you know, the city is very cats and dogs. People end up in a real silo, and it's like, I'm an equity guy, I'm a bond girl or whatever, and a bond girl. Sorry, random, I didn't intend to say that. You know, they can end up really running on rails and being very, very good at a very small niche, but not particularly good at the bigger picture. And I suppose the only other thing I'd say then is that there are a couple of times over the last 20 years where I basically thought, you know, I'd sort of had it. I mean, I was living in New York and I was like, wrong girl, wrong city, wrong job. And within a month, I'd sort of switched all three of those and buggered off to Japan, as it happens. And that's where I started writing the book. And the reason I mention that is I've had, you know, by virtue of being able to squirrel away some money, having a reasonable amount of success for my own personal investments, I've had 2.5 or more than that, no, more like 4 years of just doing my own thing entrepreneurially without having to earn a salary since I left uni in '97. And so the reason that's important is because it's basically there's one of my bookshelves, but it's enabled me to read all the books that form the bibliography of this and were the reason I was able to write it. And so I mean, up to today, I launched Plain English Finance as a sort of angry young man in you know, writing loads of stuff about how crazy it was. Nobody knows anything about finance. I launched Plain English Finance in 2011. And it's sort of developed through book, website. Now we've got a paid subscription community to a fund that we launched 3 years ago, which we may or may not come on to. It's a very plain vanilla, like UK retail global multi-asset fund. And another book, which I just did a few weeks ago, which kind of works with the community. But I should just mention for everyone's benefit that I do still have a full-time job with an investment bank in London, basically raising money for biotech companies. Right. And part of I mean, basically I still do that just because I think biotech is going to be one of the most exciting sectors of the next 20 years for Britain, for the rest of the world. You know, we're going to cure cancer. Obviously this year with COVID, it's been a very exciting place to be. And so it's a bit tricky because I can't quite give Plain English Finance the time and love and, you know, care and involvement I would love to, and which is why it's probably hasn't progressed as quickly as it might otherwise have progressed in terms of the size of our fund and whatever else. But and this is why I do things like this on Saturday mornings, obviously. Anyway, that's probably enough. I said I'd keep it brief, and I failed completely to keep it brief.
No, honestly, it's a brilliant story. And, you know, I would imagine that everyone was probably the same as what I am in regards to, you know, the experience you've had are brilliant. And that's probably, you know, when you've put that all into the book. The amazing thing is, I think for everyone as well, and for myself, is the amount of investors and what you would have learned over those years. You couldn't have got in any education, I imagine. That's
definitely true, but for sure. And I mean, just having like the CEO of EasyJet or Marks and Spencers or ASOS or ASOS. I never actually, having met them, I still can't pronounce it. And my wife's mates works for them, and just whichever way I say it, it's always wrong anyway. But having the CEO of a business like that come in and tell you face to face, you and 3 other people, or, you know, an investor who might put 50 million quid in later that week, tell you in great detail about what's going on. And having seen that from companies that are tobacco companies, retail companies, airline companies, property companies, biotech, you know, it's amazing. But what I was going to say is, By the way, stop me if I talk too much, because I've got a bad habit. My wife tells me I have a bad habit.
No, we'll listen.
Yeah, indulge me, forgive me. But actually it is, and I do explicitly say this in both of the books, it's having had the time to read, I don't know, 400 or 500 books or whatever it is, like all the investment classics, as well as the day experience. Because take it from me, the people I've worked with at top investment banks, and mates of mine who, you know, work in Sydney, Singapore, Tokyo, London, Zurich, everywhere, people with great careers at hedge funds, investment banks, to my point earlier, they become very specialist very quickly, and they're super smart, but they work so hard. They very rarely have that time that I've had to actually step out and hoover up, like, you know, all the great economics books, all the trading technical books, all the stuff I was able to read, and without which I couldn't have written that book. And quite a lot of them pull my legs. They're like, yeah, you know, I'm much more successful than you, Andy. How the hell did you manage to write the book? And it's like, well, it's because you're too busy, mate. You know, like, too busy being successful. You needed to chill out and take a couple of years off on the beach, and then you might have written a book.
Well, I think we could all probably listen to you talk about your experiences for God knows how many hours, because, you know, there'll be so many nuggets in there, and we are going to get into some of them, which I'm excited about, and a lot of these are my questions combined with, I know, what other people are wondering. But I suppose to start off from the basics of investing, you know, there are so many models out there now through the internet and social media. It can suck a lot of people in. So it's a bit of a pushback on that. Now, one thing that's probably not talked about enough is the actual, before you invest, is the clearing of debt. Yeah. You know, clearing the credit, clearing the debt. So just a quick take on that. Do you see a lot of, you know, entrepreneurs or investors or soon to be investors, they want to sort of dive straight in instead of going, actually, I should probably give myself a blank canvas?
Yeah, well, that's actually exactly, I don't know, is it the new book, the third chapter? Sorry, I'm being very salesy, like brandishing books at you. But because, you know, genuinely, I think most of what I'll say today is in one or other of these books. Obviously, a lot of the audience has read the first one, but the first bit is about clearing debt, and the idea that, you know, if an APR on a credit card is 24.9% or whatever it might be, and yet you're going to be really going some with very conservative longer term investments. I mean, the S&P 500's returned an average of 9% per annum going back to 1872, but it's done that with a lot of volatility. So 9% doesn't come, you know, regularly every year like an interest rate. So you've got to take that account. But so maybe what could you make reliably every year like an interest rate in an environment where interest rates are 1%? Who knows? I'd like to think maybe high single digits, low double digits through the cycle, in quite a defensive, low volatility way. But I think a lot of people probably will make a lot less than that, right? And if interest rates are nothing, I mean, they're, you know, zero interest rate policy on your investments, but you're going to pay away 24.9% APR on a credit card. The analogy I use in my book, which is a bit childish, but, you know, it just makes the point, is it's a bit like turning the tap on your bath and filling a bath really aggressively with the plug hole open, where if you're borrowing at 24.9% to invest at 2% if you're lucky, then obviously that is a very, very bad thing to do. And one of the most egregious things I've seen in recent years is, especially in the crypto community, is, you know, people, educators in the crypto world saying, oh, you know, crypto is such an amazing opportunity, you can't go wrong, it's, you know, Bitcoin's going to $1 million, etc., etc. Buy it on your credit card. Like, how many people got absolutely hosed in December 17 by doing? I've literally seen that happen. And so, I mean, you know, bear in mind that my whole shtick, if you like, what I'm talking about is your long run prudent money. And there's a whole section in the new book which is how I clarify the difference between investing and trading. And they are very, very different things. And a lot of times, especially like millennials who've just found crypto, or they've just heard about Robinhood or eToro or whatever, they go straight to trading without sorting investing out first. And so, you know, one of the books I'm sure many of the audience have read is Robert Kiyosaki's what's it called, Rich Dad Poor Dad. And that's like, it's those sorts of fundamentals, like pay yourself first, you know, X% of your salary every month in something really boring, get that habit set up. I mean, and frankly, if it's just savings in cash, that's better than not saving anything in cash. That's step one. Then that means you can kill any debt you've got, even if it takes you 2 or 3 years. You know, it might take some years, but life's a marathon, not a sprint, right? You've got 40 years, I would say. So then you get to the point where you've got net cash. You save up a rainy day pot that can cover you if you lose your job for, let's say, a year. I would say so that could take another how many years. But then when you're ready, when you've cleared your debt and you've got a rainy day pot of conservative cash, that's your, terrorist attack, emergency, whatever, end of the world thing where you can run away to Argentina and live in a forest. Once you've sorted all that out, the next step, and then how many years have I just articulated for many people, and I still haven't got to crypto trading, eToro, foreign currency, spread betting. I'm nowhere near it. I'm still at, okay, the next step is then with at least 10% of what you earn, whenever you get paid, whether you get paid daily, weekly, monthly, annually, whatever, you take 10% of that and you put it in something very sensible. And the latest book is all about what does sensible mean, because sensible means something very different if you're 60 to if you're 30, actually. Because if you're 30, you've got the rest of your life to try and make super normal returns and take on risk. If you're 60 and you've spent a lifetime building a pot of £1 million, you really don't want to lose 40% in a big S&P 500 crash, right? So, and I introduced the idea of 100 minus your age, which is a really simple way. This, I guess, our whole thing, because you're right, there's too much information about finance out there. You can go down rabbit hole after rabbit hole. There's like 1 million ETFs. Literally, there are more than 1 million ETFs. There are hundreds of thousands of funds. There are crypto groups. There are altcoins, or whatever other people call them. They have another slightly ruder name, which I'd probably refer to them as. There's all this stuff. There's all this confusing information. What I'm trying to do is just see the wood for the trees. Big picture, top down. It's a marathon, not a sprint. From the moment you start earning money in your early 20s till a moment where you can live on the capital, the income from that capital. How do you do that in a really prudent, conservative, automated, elegant way? And that's what we are all about. So I think I've just given you a massively long, rambly question, but you basically you set up some very simple things that just automate all of that and mean that over time you will literally wake up. If you start doing this when you're 23, 24, whatever, you will wake up when you're probably realistically, even if you don't earn much money, you'll wake up in your early 40s and be blown away by how much money you have. But nobody does it. This is the biggest problem. Nobody does this.
So I would say a good portion of everyone on here, this is something that always gets brought up on the call, is you've just explained the basics, the real black and white of setting up a standing order, paying yourself first, getting the fundamentals. I'm huge, and everyone, I'm not going to go on about it, but I'm huge on having an emergency fund and then a maintenance frontline defense. So I hope I never even touch the rainy day, but I still top it up. It's continuous every week. I never sort of dive into other things until I've done my fundamentals. I call them like my priority payments. So I always do that. So everything everything you said, we've all discussed, and I think we're all very aligned on that. So that's brilliant. And you said some brilliant points there. So thanks, Andrew. So obviously those are very much the fundamentals. Going into, I suppose, not more complicated, but more in-depth conversation, is you touched on digital currency. I just want to touch on that. And just for everyone, I'm going to get to the chat in a second, but digital currency, what is your take in regards to where is the future of that? Is that something that perhaps we really need to be looking at right now, or is this going to be 50, 60 years, or could this happen?
So your question's very timely, because I send out an email anywhere between every 2 to 6 weeks, depending on how busy I am and whether I can be bothered to sit in this room at sort of 6 o'clock on a Sunday morning and bang out thousands of words. And my next one, which I think I'm hoping to get done for this coming Tuesday or Wednesday maybe, is basically taking the section on crypto and Bitcoin from this book and just cannibalizing it and then bashing it out to our many thousand email subscribers, because it still comes up so much, and people are still very excited about it. And there's a certain age and demographic, and it's hilarious. Everyone I know who's like 70, like I've got board directors of the business, hedge fund clients of mine, just think it's just the biggest load of nonsense in history, and everybody's just going to get ruined by it. With very few exceptions, and that includes Jim Mellon, who's a self-made billionaire, right? I mean, like most of the really, really smart, super wealthy people in the world are massive bears of the whole space. That doesn't mean they're right, truly, but I think there are some real, it's a very interesting, blockchain is a very interesting technology. To be able to distribute what Bitcoin achieved is obviously an amazing technological achievement, and it is definitely significant and consequential. I would say though, I think in the whole kind of new futurist notion that you see all this stuff online about saying the world has to go to digital currency. There are a couple of things to say about that. Firstly, we already have digital currency. Go and look at two companies that are worth more than $200 billion each, Visa and MasterCard, right? Like the world has got, I'm going to dig out a credit card. We have got these little plastic things. We have got mobile phones. We've got amazing digital currency. It's not the same as a blockchain. I know it's not the same, but what I'm saying is de facto, Visa and MasterCard can do X billion transactions a month, right? And the technology is all there. It's all in place. It works incredibly smoothly. I mean, it's amazing that you could be in a restaurant in Lagos or Sydney or, you name it, or Buenos Aires, and you can pull out your Amex, your MasterCard, your whatever, and boom, today there's almost nowhere in the world, maybe Myanmar, maybe Baghdad, I don't know, even in Baghdad it's probably fine, that already exists. So what's the marginal case for something like a lot of altcoins, DeFi, all this sort of stuff? What do they add in addition? Now that there's a lot of IT security, but then again, how many times has Bitcoin been hacked? And I know it's an intermediary, it's not the blockchain itself, but it's Mt. Gox or whoever else. Well, that's this sort of academic argument that, it's unhackable, the blockchain's you can't corrupt it, It's not much consolation to you if you were one of the clients who had $50 million sitting in an exchange that got hacked, right? So, and frankly, sitting with your money at Goldman Sachs, JP Morgan, HSBC, whatever, would probably have been a better place for your money, right? In terms of the security arguments. The other thing that I think is really important, and I was saying in the book, is people argue, there's this sort of neo-anarchist futurist notion that it takes power away from states. And that's probably a great thing when you've got people like Trump and Boris and plenty of other idiots out there in the world running states and running governments. And that is quite compelling. I'm a small government libertarian. I don't care about Labour, Conservative, whatever. I think most politicians are completely hopeless. And most human progress, particularly today, comes from private sector innovation, not from the public sector. The state absolutely has a role, but the state in Victorian Britain, which is the most successful era of Britain, when we had growth rates of GDP, we built railways and ships and steam engines, and the biggest explosion in economic development in British history was in the Victorian era. Government was 10% of the economy. Today, government is more than 100% of the economy. If you put all our, that's a huge problem, right? But so that's by way of saying it. I find the idea of a sort of decentralized digital currency that goes around intermediaries like the British or American government compelling. But the problem is, whilst governments have a monopoly on violence in a polity, i.e. in a country, it doesn't matter if you can decentralize a Bitcoin and distribute it across, 1 million nodes in the world sitting on laptops, because you can't decentralize and distribute the human being who wants to use it. Yeah. And so that's where I think the whole argument falls down a bit, because if the American government and 635 congressmen and senators, 90% of whom won't understand Bitcoin, by the way, because they don't even understand the stock market. If they are convinced to legislate to make it illegal or make digital currencies illegal by, guess who? Goldman Sachs, JP Morgan, Visa, MasterCard, very deep-pocketed, politically powerful entities. If they're convinced that Bitcoin's all for criminals, and you see this argument, right? Mm-hmm. That's a relatively easy case to make. If the politicians are convinced of this, they can just make it illegal for you to use Bitcoin. So then it doesn't matter if it's all stored on a USB. If you turn up at JFK Airport and you want to fly to wherever, and the authorities put you in cuffs, game over. So I think that's a very real risk to the whole cryptocurrency space that isn't taken sufficiently seriously by cryptocurrency enthusiasts. The countervailing argument to that is that, and this is another point I make, is that quite disappointingly, if you're a kind of neo-anarchist futurist who wants to, if you want to disaggregate the institutions of state and big nasty investment banks and people like Amazon or Microsoft or whatever, ironically, those are the entities that are going to win in this game, right? Mm-hmm. JP Morgan, Goldman Sachs, all their in-house white papers on their own crypto systems are going to be the ones that win longer term, in my view. So I don't know if that's helpful.
So, well, I mean, it's touched on the point of, so are you saying essentially for digital currency really to, and I know what you mean, obviously we've already got digital currency in a certain way anyway, but in regards to the crypto sector and, the Bitcoin actually becoming formalized and essentially backed by government, what you're saying is there's huge hurdles they would have to jump.
Yeah, well, look, I'd say, so don't forget that America's power, we're getting quite political here, but, if everyone cares, America's ability to project power in the last century since the Second World War has rested entirely on the use of the dollar as the global hegemonic currency, right? The Pax Dollarum, okay? And especially since 71 when they came off the gold standard. There are 3 countries in the last 30 years or 40 years that have tried to come off the gold standard to trade oil. Sorry, to come off the dollar standard to trade oil, because America is made immeasurably wealthier and immeasurably more powerful by the fact that we all have to use their currency to transact in oil, cotton, coffee, copper, you name it, right? It's a global dollar system. Everything has to be swapped through dollars. And there are 3 countries in the last 50 years that have tried to create a gold-backed dinar, whatever, a currency so that, they could trade with each other in oil without having to buy billions of dollars worth of dollars. Can you guess which 3 countries they are? Iraq, Iran, and Libya. So my point is, Bitcoin is in the corridors of power in the Pentagon and in the EU too. These the sort of people who are part of the Bilderberg group or go to Davos every year to the big global economic forum. The global elite. By the way, I don't think the global elite are anywhere near as coordinated or nefarious as people think they are. And the world is not run by the Rothschilds, right? It's, you can't get one footsie board to agree on anything, let alone 100 incredibly rich people from all over the world with their puppet strings. It's nonsense. But that doesn't change the fact that the power structures do exist, and the Pentagon is very powerful. One of the biggest threats to that power is decentralized currency that bypasses the use of the dollar, euro, yen, sterling, right? The global currency system is kept in place by the threat of military force, like as a statement of fact. So I think Bitcoin at the moment crypto as a whole sector is so small. I mean, people talk about X billion or low $1 trillion. That's nothing. That's like one neighborhood in London of property. So, like seriously, like when you actually think it through. So you think how many thousands of cities, millions of people, billions of people. It's so small that none of the power structure are particularly threatened by it yet. I think longer term, they will co-opt it. So that's the sort of bear case. The bull case is, and it's a case. It's the reason I'm a gold bug. My preference for playing this theme is gold, personally, right? Because I think gold's got a 5,000 year track record and isn't that volatile. Bitcoin's got a 7-year track record and is unbelievably volatile. Ultimately, high volatility returns are much lower quality than low volatility returns. If you make 10% by making 0.83% every month, which is what all the big hedge funds in the world do, by the way, that's what their main aim is, to just grind out 1% a month, basically. Not all of them, but many of them, the ones who run $100 billion. If you do that, that is immeasurably more value than buying Bitcoin, having it go up 200%, then crash 60%, then because psychologically you're much more likely to win if you're winning little and often, like the tortoise wins the race, right?
Yeah.
And I think, but I think that's why I prefer gold to Bitcoin per se. But I think that the same theme could well mean that Bitcoin in particular could well become a very valuable thing. Because I just think that the chance of a currency reset, especially now with this year in coronavirus and trillions and trillions more of QE, why is the S&P 500? Everyone's confused. Like, how can Main Street be so screwed? Like hundreds of millions of people all over the world are unemployed. Everyone works from an airline or a restaurant or a hotel, or they're all furloughed. In every major Western democracy, and God knows what it must be like living in India or Nigeria right now, and it's just because we don't hear about that, right? But the poverty, the real world poverty, and the economic challenge of this coronavirus situation this year. Yet the S&P and every other major market index is at an all-time high. How is that? It's because it's all in funny money.
Yeah. Well, sorry, go on.
No, I was going to say, and that that same theme, as it tops off, all other things being equal, probably does mean that Bitcoin's going up. But I just think that, but so's gold, right? And for me, there's a bigger, no government, well, don't forget, gold was illegal to own between the 1930s and the 1970s as an American citizen for very similar reasons to why they might make Bitcoin illegal, because it gives you power. But the good thing about gold is nobody needs to know I've got some in my cat's litter box at home, right? Not saying I have, obviously, but you can gold, diamonds, things like that. Actually, you can carry a huge amount of money across borders in a small piece of gold.
Yeah.
If a security, I mean, this is kind of crazy post-apocalyptic, the Matrix kind of chat that we're having, but stranger things have happened, right? And whereas Bitcoin, I think, if you much as you think, oh, I've got it on a USB stick, that's the same. Well, somebody could, the feds on the way into Boston airport could go, right, open your laptop up, and I think here I am. Gold is more smuggleable than Bitcoin, is basically what I'm saying, which I probably shouldn't be saying. But
so tip from Andrew, we can smuggle gold. In a litter box, like it. But no, we're going to get on to
diamonds are even better. Diamonds are really small, but obviously there's too big of a spread. You lose loads of money when you sell them back. Anyway.
Oh, well, this is, I absolutely love all this. So this is awesome stuff, Andrew. So we're going to get on to gold. We're going to get on to what I'm going to do, Andrew, if you don't mind. I'm going to open up the chat, and if we could do like a quick fire answer from you, Andrew, because I then want to just move on to the next topic. So I'm going to read them out.
Just before we do that, and this is really boring, but everybody knows I am regulated personally as an individual, and my company is regulated by the Financial Conduct Authority. We're fully authorized and regulated by the FCA. And I just have to say, sort of by law, per what my compliance people tell me, that it's like a boring disclaimer. Nothing I will say should be construed as personal financial advice. I should have said that right at the beginning of the call. After telling you to smuggle gold, I think the FCA will probably have a problem with that anyway. So when I answer questions, I can only answer in general terms. I can't say, you specifically, John or Sarah or whatever should do this. I'm not allowed to do that.
No, that's cool.
So cool. You want me to just read? You want me to
go?
What
I'm going to do, I'll just quickly read them out then, Andrew. So should I have, as part of my portfolio, my pension being assets such as ISAs and bonds? Should I have this as part of my portfolio, the pension?
Yeah. So that was one of this book is my really boring book. Which, by the way, you get for free if you join our Facebook community, which is $5 a month. So I think it's pretty good. There's my sales pitch. But the reason I mention it is because, so how to own the world, which many of you have read, as you say, is very much kind of the big picture, the theory, whatever. The new one is much more the nuts and bolts of, all right, fine, that's really helpful. Which accounts do I open? How do I think about ISAs versus pensions? Once I've got my ISA, what should I actually put in the ISA? I mean, cognizant that I can't specifically say you should buy this, but what I have written about is the idea of so I talk about how long run investment success is 90% admin and 10% asset selection, and I really mean that passionately, because if you've actually sorted out what happens every month when you get your money, or or every week, or as I said earlier, on whichever cadence you get paid, and you've sorted out all the best tax efficient accounts in the right kind of order, which to me are kind of ISA, precious metals, pension, for once you've got quite a lot of money and you've been doing it for years and you're brave and you know what you're doing, possibly spread betting, whether that's Forex or indices or whatever. Once you've sorted out that infrastructure of accounts, that's a huge amount of the battle won, and money will just pile up and accrue. And once you've set up that infrastructure of accounts, you can kind of use, certainly for your ISA and your pension accounts, you can use quite a broad brush approach to both of those. And what I talk about, as I said a minute ago, I'll explain it in a little bit more detail. I call it 100 minus your age. And basically you take 100, subtract your age. So let's say you're 30. And what that tells you is that 70% of your ISA and pension money could potentially be in what I describe as aggressive assets, and 30% should be in defensive assets, right? Because it goes to my point earlier, if you're 25 and you've built up 10 grand of savings and you're long, you love Bitcoin and you've just been hosed and you know it's halved, you're down 5 grand, which sucks and is annoying and blah blah blah. But if you're 60 and you've just done the same with £1 million and now you've got 500 grand, like when you're just about to try and retire, that's suicidal, you know, that's like properly stressful and terminal. So that's the first lens through which I present the idea is, and let's be very clear, this is for your long run investing money. This is for your set and forget. You know, my employer gives me some money for my pension, or every month I try and save 10, 15, 20% of what I earn, whatever it is you can put by, and it goes bloop, like Robert Kiyosaki style, you know, on autopilot. And then the next consideration is the aggressive versus defensive allocation, which change it. And then we just say, this isn't something you need to do every month or every year. I say basically every 5 years. So, you know, if you're 40, you should be 60-40. If you're 45, you should be 55-45. If you're 60, you know, every 5 years on a rate, don't react to the news or coronavirus or Trump winning the election or losing the election, or just, you know, do that, and just every 5 years or so, do the admin to reallocate your big picture long-term money. And then the next question is, okay, well, what is aggressive and what is defensive? But then, so that's a very long and rambling answer to a question about ISAs versus SIPs. But it's all in that book in terms of. So I think the ISA is the #1 product for anyone under about the age of 50 in Britain, and the reason for that is that I think the pension system is probably going to change a hell of a lot in the next few years, because it has to, with all this funny money and QE and whatever else. You know, there are pension liabilities left, right, and centre. And if any government is going to legislate to change and take money out of the sort of aggregate British pension pot, they're going to do that. And they're not going to do it with ISAs, because ISAs is so much smaller a pot. Mm-hmm. And ISAs in the main are owned by Britain's elite as well, by the way. So I mean, I genuinely believe that. I think so. ISAs are tax-free. You know, you can put up to 20 grand a year into an ISA, 40 grand a year for a couple. So if one half of a couple just happens to earn a lot more than the other half, he or she can pass back the money tax-free. So effectively, if you're a very high earner and you're married, you can put 40 grand a year into an ISA, and that's a lot of money. Like, you know, if you do that for 20 years and you return 10%, you'll be a multi-millionaire. So, you know, why would you mess about doing all sorts of more complicated things?
Well, that's something we're going to get onto. Actually, you touched on the whole touching of pension and ISAs, so I want to come back to that. So I appreciate that answer. I hope that answered. That was for Shane. So thanks for that answer, Andrew. Right, quick one on this one then. So making our way down from Sam Norris. Okay, so as a new company, plans to invest, hopefully aiming to have 200 to 300k in 12 months. We also have personal debt. What would we? Obviously, I don't think there's advice here, but to pay. Yeah. What do you think of that one?
There's not quite enough. Yeah. Firstly, I can't give personal advice. Secondly, there's not quite enough information there. But as generally, I mean, so if you're going to have 200 to 300k in the company in 12 months, all other things being equal, I think, not giving personal advice here, of course, you should pay off any personal debt you have as soon as possible as your highest priority, as we said right at the beginning of the call. The only other consideration about this, though, is that getting the 200 or 300 grand out of the corporate entity, the limited company or whatever it is, into your personal situation so that you can then use those funds to pay off your personal debt, obviously will attract a tax liability. So I guess the only, yes, all other things being equal, without knowing more detail, you should always get rid of personal debt as your #1 priority. But there might be wrinkles around getting that money out of the company to you personally, like your tax concerns or whatever else, that might make it better to keep it in the company, depending on your personal circumstances. In terms of, and the other thing is to say is, don't forget that if similarly, it's a tax concern, but if you, so Plain English Finance is a limited company, which I own a majority stake in, right? So any money in Plain English Finance, I can use to buy a laptop or, you know, a flight to somewhere, as long as it's a justifiable business expense, or a nice lunch with a potential investor or whatever. You know, and this is obviously most people, lots of people in here will understand this, and I suppose this is a benefit for some people who don't. But so once money's in the company, do use the money off the top in the company before you pay it out to yourself to use it, because obviously, to the extent you're permitted by law, That's much more tax efficient. So I hope that vaguely helps.
Cool. No, hopefully that does. And that was for Sam. So thanks for your question, Sam. What I'll do, because I can see the questions are coming up thick and fast, I want to get through these now and then get on to the next topic. So what I'll say is, Andrew, if you're happy, should we do like a quick 20, 30-second answer and we'll get through these if we can?
Just before you, so John has sent me a private message saying, other than my book, what would I recommend? So it's only to me private. So I'll just say, I recommend there's 300 books in the bibliography at the back. So that's a pretty good starter for 10. And I also wrote an article about the 8 best investment books of all time, which you can find on my website. So there's 8 of them to get started with.
Awesome. Thanks, Andrew. Okay, so from Lewis, quick fire answer, and then we get through them. What advantages does the individual investor have over the professionals in the city in terms of investing in all assets?
Yeah, so quite a few actually. And again, I talk about this in chapter 2 of the first book. So in no particular order, in the city, there is a really big groupthink problem, right? So top fund managers at top fund management outfits have to go, I want to buy, I don't know, Rightmove, or, name a company, Britvic, Games Workshop's been a real darling in recent months. I think that the more little boys are going to want to be complete geeks and sit in their bedrooms painting little figures of orcs and dragons. Let's buy Games Workshop. All I think is being equal, that's an idea you could come up with. It's potentially a good idea at the right valuation. You go and pitch it to your investment committee, and it's groupthink. You have to get it through the investment committee before they can make it. So that'll take a long time. So actually that's a problem. If you've got 100 grand of investable capital, let's say, you can basically buy, sell, do whatever you want with all of that capital in 5 seconds, or in almost anything. There might be a few micro cap stocks at the very bottom end of the London stock market that you'd struggle to buy 20 or 30 or 40 grand's worth. But actually, all of things being equal, you can deal immediately. If you're running £1 billion, you can't. It'll take your traders days to buy and sell stuff. So those are two like structural advantages that the private investor has over a professional investor. The other one I'd add, which is similar to groupthink, is compliance. So the FCA, there have been so many scandals and mis-selling scandals and whatever else that the FCA is incredibly, you would not believe that a regulatory oversight of trading and those sorts of activities in the city for professional investors. All your phone lines are recorded. Those recordings have to be kept for 7 years. All your emails have to be kept for 6 or 7 years. You can't breathe. You can't do anything without, you have to keep records of why you decided to buy that thing, et cetera, et cetera. As a private investor, you don't have to do any of that. So it's basically you're a little fighter jet, and a big institutional fund manager is like a massive super tanker that takes 2 miles to turn around, basically.
Yeah. The flexibility and then having to follow compliance, basically.
Yeah.
Cool. Thanks for that, Andrew. That was for Lewis. Tabo, let's jump on to you. So in the book, you mentioned about inflation being understated in the UK and US. If I'm running a property rental business, should I be increasing my rent by 10% annually?
I wish you luck going to your tenants with the shadow stats emails or link saying, do you know that because of geometric weighting, hedonic adjustments, and arithmetic calculations, the UK inflation rate is much higher than CPI and RPI, so give us 10% more rent, please.
Yeah.
You certainly have a crack. It's an argument that can be made. Look, at the end of the day, inflation is incredibly hard and subtle a calculation, because ultimately every single individual has their own inflation based on what you and I buy. And so calculating it from a basket of even a few hundred. So I think there's no question. You just have to look at property prices, stock market indices, the cost of a pint of beer in central London, whatever. I mean, I think I used to pay 80p for a pint at university, and it's now quite often in London it'll be like, that'll be £6.50, please, and that's 20 years later, right? I mean, and people don't even think about that. And that's like hundreds of % increase in a very basic thing. So I think inflation is unquestionably higher than the sort of nonsense numbers that obviously governments use to make calculations about what pension they should pay people. Funnily enough, they keep those numbers as low as possible, right? But I think ultimately, whether or not you can pass whatever the real number is onto your customers will be a function of how much value you're adding to your customers. You know, you should certainly try, you know, and but I would say that 10% is quite punchy.
Yeah. Yeah, good luck on the conversation, as you say.
Yeah,
sort of,
yeah.
Because everyone's in their own situation. So, and like you say, inflation differs to everyone what they buy.
And yeah, please don't print out the inflation section of my book and take it along and sort of put it in front of them and go, you know, you owe me more money. Then people stop burning my books.
Okay, cool. Thanks, Andrew. On to Dean. As someone who is looking to start investing in a stocks and shares ISA, is now a sensible time, or should I be more cautious? You got a quick answer on that one?
I love that question. I literally wrote a piece the other day, which I think is one of the sections in here, about ignoring the news. Where I basically say every week somebody gets in touch with me saying, oh, I've been thinking about investing for, you know, my wife and I really want to invest, but we're just wondering if now's a bad time. And my answer is, the best time to start investing in something like stocks and shares ISA is always now, always. Because 4 years ago, it was Syrian refugees and North Korea. And there is something every single week, month, year, throughout the whole of history since journalism invented that will tell you now is not the right time. Like the right time is to have the right allocation to aggressive versus defensive based on your age, and to try and save it as at least 10% of your income every month, automatically into an ISA. And yeah, there probably will be a very big stock market crash soon, right? Because it's insane. I mean, look at Apple and Amazon and Microsoft, they're all trillion, you know, or $2 trillion companies. There's just been this huge, but it's probably going to go up a lot more before it goes down again. Yeah. And if you sit around waiting to time is now the right time, nobody can do that. So yeah, just go for it, and obviously buy my new book, because then you'll know exactly what to do, or reasonably what to do.
I don't think there's anyone left that hasn't bought it, Andrew.
Well, you might not have got the new one. You might not have got the new one.
No, that's cool. Okay, thanks, Andrew. So next question, I'm going to do 2 more. I'm going to do 3 more questions, and then I'll come back because the questions are just flying through. Yeah. Okay, right. From James, what is the ideal way to work out the true inflation?
Yeah, I mean, as I said, it's basically impossible, right? Because it's about you as an individual. You know, if I want to eat cat food and somebody else wants to eat foie gras, you know, my meat inflation is going to be lower than theirs. So it's a very, very capricious thing. But I think my actual view, if you want a kind of rule of thumb, look at what the gold price is doing. And I can't remember, it's goldprice.org or goldmoney.org. One of them has this amazing chart, which I reproduce quite a lot in my emails and in the books, which is basically gold's performance in every major currency in the world over like 15, 20 years. Mm-hmm. And it's, you know, it's running anywhere between 5, 6, 7% and 14%, depending on which currency. So to me, it's basically monetary, the monetary deflation. So the devaluing of the pound, euro, yen, whatever, is roughly what real monetary inflation is. Yeah. And and gold tends to capture that, which is why I think gold's such a good fundamental hedge. Well,
I want to get onto gold. So that's something I really want to touch on because, we're going to get onto that. So from Radhika, again, thanks, Andrew. From Radhika, in your opinion, what is the safest way to invest some of your money for addition, safety funds, or extra emergency cash? So
yeah, in the new book, I talk about building up a rainy day pot, which I said at the top of the call, which, depending on how secure you feel, how skilled you are, whether you've got kids, et cetera, should be anywhere between like 3 months and 12 months of your living expenses. That should always be in cash, in my view. Even though I'm a massive bear of cash and I hate cash, I still cash, you know, ultimately anything less than a year time frame should be in cash if you need it back. Because even, you know, if you buy gold or the stock market, whatever, gold has periods where it will fall 15, 20% pretty quickly, and the stock market will fall 25, 30%. And any investment fund, well, I could say our fund, but obviously that's really, so our fund's worst ever peak to trough fall in 16 and a half years of backtesting and 3 years of real world performance is minus 10%. So that's if you bought at the highest high and sold it at the lowest low in a given year. And its worst ever negative year is minus 6.6%. So I get paid in my day job. I'm an LLP partner, not a PAYE employee. So I get paid each quarter in cash. And so there can be 6 months between when I get paid and when I have to pay HMRC my tax bill. And I do put that money in my fund. Because I think, well, worst case scenario, if the fund falls 5-6% in that time, I can still afford my tax bill. It's just going to be a bit annoying. But of course, if it goes up 3 or 4%, then I'll have more money in my tax account than I need to pay my tax bill, which is great. And I can take Rachel out for a pissy meal or whatever. But, you know, or a holiday, depending on how good a year I'm having. But yeah, generally the advice should always be anything emergency, anything less than a year is cash.
Cool. And we're talking liquid cash in a bank or in physical cash, I take it.
Yeah, exactly.
Yeah, cool. All right, lovely. Okay, last question before we crack on from George. Can you expand on your chapter about inflation in the book with the large amount of QE money printing that's gone on in the US, UK due to COVID? Could we see large increase in real inflation in the coming year?
100%. I think we've already hit these themes. That's why the S&P is at an all-time high, even though, you know, as I said earlier, you got tens of millions of new unemployed people in the world. You've got every football match, rugby match, cricket match, you know, industries, compromise, leisure, sport, hideous economic cold winds all over the world. Yet you've got the S&P's at an all-time high. Apple's the biggest company in history by some margin. Is up like 50% this year. It's insane, right? Yeah. You got, you know, and then I think everybody would have seen as well, UK house prices are at an all-time high.
Yeah.
You get the highest unemployment number for like a generation, I think, since the Second World War, right? And it's only about to get worse. Yet all these financial indices are all-time highs. That is inflation. That's you know, and the problem is that, you know, in order to keep up with that, you need your salary to go up by the same. Is your salary, you know, if a London house price goes up 10x, you need your salary to go up 10x. But most people's salaries have only gone up 2 or 3x over the same time period.
Yeah. So we are going to see dramatic.
It's going to get brutal, I think. Yeah, but ironically, I hear a lot of people that you know, there are lots of talking heads I see on Facebook groups and stuff online who, you know, dare I say, in the crypto space, who say things like, "Oh, debts are going to be all-time high. You know, that's massively bearish for the economy. You should sell for the stock market. You should sell the stock market." No. It's massively bullish for the stock market. Because the more debt there is, the more liquidity there is sloshing around, and the lower the real intrinsic value of a dollar, the higher the stock market will be nominally. And it's very important to understand the difference between nominal levels and real levels. You know, nominal doesn't take account of inflation and real does. So if all this QE and tens of millions, trillions, you know, billions, trillions, whatever of new money comes in Europe, Japan, the UK, the States, you better be long stock markets. Because the worst possible thing to do is sell out and go, "Oh, there's going to be a crash," and be in cash, because cash is the one thing that's going to get killed. Cash is limitless. The cash is without end in terms of supply, but there's only actually 500 really good companies in America in the S&P 500.
Yeah.
So this has already happened. This is why Amazon is a $2 trillion company, right? Sorry, Apple and Amazon not far behind.
So is it not a bit contradicting in the sense that we should, because obviously we're building up these, you know, these rainy day and the emergency funds.
Yeah.
But essentially, could it not just be absolutely worthless anyway? So we're building up these pots, but essentially we risk them just being worthless, which brings me on to gold. Yeah,
that's a good question, and it seems illogical, but I still think that anything less than a year should be in cash.
Yeah.
No, I mean, you know, because basically you need, ultimately, even if real inflation's running at 10%, if you've got 10 grand saved against whatever, but at the end of the year you've got 9 grand in real terms, it's not, you know, it's not going to plummet 90% in a year, right?
Yeah.
Well, let's hope. Otherwise, we're like Weimar Germany in the 20s, and then there'll be another world war, which it wouldn't be great.
Might be great. Yeah. Well, I'm going to go on to gold. I'm going to dive into gold now. I would originally just purchase from Royal Mint, as a lot of people did, but from your recommendation, Andrew, when we spoke a while back, I ventured into Sharps Pixley, which been purchasing from. So that's great. But Sharps Pixley, funny enough, actually accept Bitcoin as a purchase, which I found interesting. There's obviously a bit of a sign there. Sharps Pixley have been around for a long time, as you know.
1768, I think, was when they opened that shop.
Yeah, I think it was right about that. So so that's brilliant. But in regards to gold, My view on gold is very much is that, as obviously you mentioned quite a lot, is that hedge. You know, it's that insurance policy that I suppose even if things ever did move into Bitcoin or crypto, gold, you'd still be able to actually transfer and purchase that Bitcoin if we needed into the future. If the cash became worthless, the gold is essentially that transfer platform to go and buy what might be the new valuable currency.
Yeah.
So what I want to ask in regards to gold, because people are thinking about buying gold or have just dipped their toe in gold, and I'm a big gold lover, but someone who's perhaps thinking of buying gold now, can you just sort of elaborate on the reasons really why you should be buying gold? Because I also agree with Robert when he says it should be dead money, as in you shouldn't need that money if you're going to invest in it. It is an insurance.
Yeah, I mean, so the structural story for why I believe in gold is it's either chapter 6 or chapter 7 of my first book. So go back and look at the argument. So it appears a couple of times that, there's sort of, there are lots of demand side arguments. There are lots of supply side arguments. Ultimately, economics 101, if demand is going up and supply is going down, the price has to go up, right? Over time. So, and then there's also the price and supply of money. So, people find this a bit difficult intellectually, but basically, if the whole Warren Buffett thing about that all the gold ever mined can fit in 2 or 3 Olympic swimming pools or whatever. It's unbelievably dense and there's not much of it around in the world. So in a world where that is true, and if you go online, you can find like Visual Capitalist has done pictures of what it looks like, and it's quite cool. In a world where that's true, but where a money supply of dollars, pounds, euros, yen, Swiss francs is basically infinite, gold priced in those things has to go up. Which is that, and that is all. That's why it's gone from $35 in 1971 to $1,900 today. But the trouble is, here's another way of thinking about it though, is that is more the devaluation of the dollar than the increase in value of gold, right? Yeah. That's an important thing to understand. So somebody made the point to me years ago that, when an ounce of gold was, I don't know, £1,500, let's say, that can buy you like a really flash Savile Row suit. Like or like a Gucci or Dolce & Gabbana, shiny suit from Harrods or whatever, 1,500 quid, let's say. And amazingly enough, an ounce of gold in the Roman Forum in 30 AD, under Emperor Justinian or Hadrian or whoever it was back then, could buy you a really flash toga. And it literally what an incredible store of value that over 2,000 years, the basic clothing item costs 1 ounce of gold, and that has not changed in 2,000 years. When however many dozen currencies that have come and gone have gone to zero in that time. So that's why that, and then the more prosaic demand stuff is that, well, gold mining gets harder. Like all the big mines in South Africa now, they have to pull out 200 tons of rock just to find enough gold to make a wedding ring. It's nuts that like any other commodity, it gets harder and harder to find it, unless Peter.
Will that rarity also, obviously gold goes up in its value anyway, but like you say, the fast growth comes from the devaluing of our currency. That's what gives it that edge. But as it becomes harder to mine, will that also result in its quicker growth?
Well, that's certainly what crypto enthusiasts think about crypto, isn't it? About Bitcoin, isn't it? But all other things being equal, any product has to take account of the cost of production, right? As one of the factors embedded in price, because otherwise you lose money when you sell it, right? So all other things being equal. But the one thing I would say though, which is a bit of a sort of cheeky aside, but is actually potentially might even happen given with the progress Elon Musk is making. So there's a guy you may well have heard of called Peter Diamandis, who wrote an amazing book called Abundance: The Future is Better Than You Think. And he and Elon Musk have got a number of companies they founded together. And one of them is an asteroid mining company. And their plan is to basically land on an asteroid and hoik a whole load of gold and silver and nickel or zinc or whatever other elements you can find on an asteroid and bring it back to Earth. So, and actually, do you know what? Mad as that sounds, there's a historical precedent for that. That actually happened. Well, it wasn't from an asteroid, but when the Spanish conquistadors conquered like Mexico and Peru, the Incas and Aztecs, whenever that was in late 16th century. there was suddenly, they found tons of silver and gold, like they basically quadrupled the world money supply of silver and gold. And of that all flooded back into Europe and caused a massive economic problem. Like if you ever go to any of the museums in Bruges and in Belgium, you'll see all this stuff about how Bruges was like the sort of modern day. It was the Singapore of today was Bruges in like 1550, right? And Bruges' economy got completely destroyed with silver inflation because all these Spanish people came up with tons of silver and bought everything, you know. And so anyway, sorry, it's a bit of a spurious aside, but I guess what I'm saying is, you know, there are always unknown unknowns, and you know, the supply of gold, based on the information we have available to us now about mines in Africa and Australia and South America and stuff, is becoming more and more challenging. The supply of money is going to infinity by all accounts. Therefore, it's a buy. But just watch out. Have you ever seen any news about Peter and Elon landing a space shuttle on an asteroid? Then you probably want to be careful about your gold holdings. Maybe then you should switch to Bitcoin at that point.
Well, we'll have the gold to trade it, right? So
yeah,
no, that's cool.
But, I mean, like, it's another one that to me you just buy every month.
Yeah,
and I do in the new book. Actually, and you can get it for free. You don't have to get the book. I wrote a 3 email series on my website. So it's the opinion section of plainenglishfinance.co.uk or .com. Both of them work. It are all my articles going back like 5 years. And if you just click back a couple of pages, there are 3 articles. The first one is called "Which Asset Class Has Averaged 12.3% in the Last 16 Years?" That's the introductory article, saying which does highlight the gold story overall. And then the next 2 are called "How to Buy Gold Part 1" and "How to Buy Gold Part 2." And there's an upgraded version of that, updated in the appendix of the new book, which talks about why would you buy physical or use an ETF or use an outfit called Bullion Vault, or maybe use spread betting, like all the different options, what that means for tax, etc., etc.
Yeah, I'd say if you're interested in gold, go check those out, because I've read those and they're really helpful. So
and go to Sharp's Pixley, because like you basically have to go and drink a dry martini in one of the bars nearby, so that you feel fully like James Bond, and then walk into a shop that actually sells gold bars. It's brilliant. You go, I'll just have one of those, please.
Yeah, no, they bring a brilliant store, to be fair. Customer service is spot on. So
yeah.
Okay, cool. Well, moving on from gold, I want to touch on pensions, because this is something that is I'm quite interested in. I stay very close to, but I want to know your thoughts on the reality of pensions for millennials. There's a lot of change. I see that now for millennials, essentially those retiring in 2060 or whatever it might be, they've been put back another 2 years. What's the reality of, with all this QE going on? Could we see a result that we might not actually ever see our employers' pension or our private pensions? Could they be dipped into and taken by the government?
Well, that's exactly the point I make in both of my books, right? And I give one specific example from history. There are plenty of others. I mean, Germany, after the First World War, the German pension system was nationalized, which is part of why Hitler came to power. There is a very real risk of this, I think, all over the world if you're actually looking at the numbers. And an example I used, which was in 2008. So I actually, when I lived in New York, I had quite a lot of Argentinian mates, just randomly, a few people I met and used to run around with. And I went down to Buenos Aires a few times. And Buenos Aires is not that dissimilar to a European city. It's actually it's not like it's a developed country city in many ways. It's got, it's a beautiful city. It looks very European. It's got lots of wealthy people driving Mercedes and Golfs and stuff. It's a pretty advanced place. And yet the Argentinian government nationalized private pensions in 2008. So if you had been saving and investing, you work for a big Western company, like you work for Shell or I don't know, a drug company or whatever, and you've been diligently saving into your pension for 20 years, like the parents of quite a few of my Argentinian mates, and then just one day you wake up and the government has taken that money away from you. And that actually happened in 2008. Now,
how can they actually do that? I mean, what is the real risk for us that
well,
they could potentially?
You got to think that for that to happen in Britain is just, insanely. I mean, that would fly. We invented pensions, right? Scottish widows in Edinburgh, and I mean, it's one of the great things about being British is that our financial service is the best in the world, truly, and which gives us quite a big advantage over, even countries like Germany, frankly, or France, and although they are catching up. But I think the risk is small, but I do think it's enough of a risk. Or it's only so in the last 10 years, Gordon Brown changed the rules and basically took the lifetime allowance from 1.8 million down to 1 million. And that is basically taking money away from people who, obviously pretty rich people who've done a really good job with their pensions, but still, they changed the tax treatment of dividends in pensions. Every government of every stripe has basically been chipping away at pensions, and they're almost certainly going to have to chip away at them more because of all the money we're spending. It doesn't matter whether it's Tory or Labour under either colour of government. And so my reaction to that is that so in a world where you have auto enrolment, and if you have a conventional job with a normal employer, who particularly if they're willing to match your contributions and give you free money in your pension, then you should take as much of that as possible, because on a risk reward basis, you're getting 100% free money. Just make sure it's invested in the right kind of places. Don't put it in their really ordinary rubbish pension funds, which, doesn't take that much work to figure out how to sort of do it in an own the worldy kind of way. But I think particularly if you're, as I said earlier, if you're under the age of 50, certainly if you're under the age of 40, you need to really be making sure that your financial affairs are legislating for a future of, hopefully not working from, 50 to 80 or 55 to 85, whatever it ends up being, and being able to really enjoy yourself, which is a very realistic aspiration if you start doing this stuff in your 20s, by the way, particularly. I always say it takes about 20 years to become meaningfully wealthy, if you kind of regardless of your income, although the more you make, obviously, the easier it is. You definitely, you could use the pension as a vehicle and as an account, but I do talk specifically about the running order. I think you should make damn sure that you've got your ISA sorted as well, or as a higher priority.
Okay, brilliant, great answer. What I'm going to do is I've got a few others, but see these questions just building up like anything. So, Andrew, again, if we can just do, if we can get through perhaps 5 questions, and we just absolutely we just get through them.
Okay.
Cool. Matt, let's try and get through this. With the government pulling money from everywhere, bounce back loans, furlough, do you think there will be quantitative easing due to this? What do you think this will result for the UK world economy?
Yeah, it's all the same theme. Goodness knows where we're going to go next, but we're going to go. Here's a fun fact for you. The British state, if you put everything on balance sheet, all the PFI loans, all the unfunded liabilities and commitments of trillions of pounds from future pensions and hospital NHS trusts and roads and everything, the British state is a higher percentage of the British economy than the communist state was in Russia in the 1980s, because under communism the 100% state never actually was 100% state, because about 50% of the economy was the black market. Mm-hmm. The British state is already basically more than 100% of our annual income by some margin, and our deficits are running up 2-3 trillion pounds. So, but the irony of this situation is sort of how long can the rubber band go before it snaps, right? Because this has been happening for 50 years in America. Obama put more debt into the American government than all the previous presidents in history in his 8-year term. Okay, like. How together, like if you add up the debt that was accrued by the other 100 and whatever US presidents since 1789 or whatever, Obama added more debt himself in 8 years. Okay, but now, which by the way, which is why Apple's the value Apple is, and Facebook. And
where does it end though, Andrew? That's I suppose it's obviously that's a question you probably can't give the right answer to, but where does it actually go to?
We're in a race between two things, in my opinion. One scenario is fire, brimstone, apocalypse, the Matrix, truly, and a monetary reset, in which case gold and or Bitcoin but also companies, like legal title of owning companies will be valuable, because people will still need water and property and food and whatever. So that, a big currency reset, people being really impoverished. I think we've been doing that in slow motion car crash for like quite a long time now, which is why you look at America, there's so many unbelievably poor people in the sort of flyover states between California and New York. And then there's so many unbelievably rich people in the sort of, it is like something out of a science fiction movie, right? It's like all the poor people living in the desert in the middle, and then all the rich people living in their towers and whatever. But do you know what? The other scenario, which is part of why I love working in biotech, is actually, might it be that these hyper-productive technology, the other scenario is that technology saves us, is that human wealth in terms of a roof over your head, running water, sanitation, fresh, healthy, sanitized water, electricity, blah, blah, blah. Ultimately, for all of us to have that, all we need to do is refashion the periodic table. Okay, we need to apply energy to the elements of the world. And that's what human beings have been doing for like 500 or more years since the agricultural and industrial revolutions. And we've been getting better and better and better at it. And we're getting exponentially better at it. And might it actually be that rather than all this really depressing stuff about monetarism and is it possible for there to be 100 $3-4 trillion value companies in the world by the time I retire, right? Which will be from China and India and Brazil and America and hopefully Britain and Germany and Switzerland, all of whom do unbelievably miraculous things in the way they fashion our buildings. They deliver free, abundant electricity from solar power. They deliver new telecommunications technologies. We've cured cancer. That's the Star Trek scenario. I suppose we're in a race between the Mad Max scenario and the Star Trek scenario, right? And actually, working in biotech, I feel a lot more confident that it might be Star Trek and it might not be Mad Max because of what I see, just the miraculous stuff these companies are achieving.
It's funny you say, because I did a video on YouTube on gold, and I sort of touched on, if anyone's seen it, the Book of Eli. Could things ever go back to Denzel Washington? Where you're robbing each other and you want to know what each other's got in each other's.
Well, The Road. That film, The Road, with Viggo Mortensen.
Oh, I've heard of it. I haven't seen. I
wanted to kill myself after I watched that film. It's so depressing.
But that's what I mean. I can't quite comprehend that it could actually go that way. I mean, instead of investing in gold, I'd be buying another shotgun.
That's exactly it. That's it. And that taken to its logical end, you'd be better off buying a farm in like Croatia and a load of rifles and a load of tinned food and loads of fresh water, to survive. If you reckon you can survive for another 30 years biologically, then you need to lay in 30 years of that. If that's what you really think is going to happen. And I think you're right. There's a great quote I used in one of my pieces from he was pre-Victorian. He was a Georgian historian called Thomas Babington Macaulay. And the quote is something like, how is it that when all we see behind us is progress, all we see in front is destruction, or something? And actually, the biggest counter argument against pessimists who think the world is, by the way, humans are hardwired to be pessimistic, and our press are hardwired to telegraph, megaphone that back at us because it sells papers and it works for clickbait, right? Nobody wants to know that 99.5% of the world's population hasn't got coronavirus. No newspaper is going to go, guess what? Today, 99.5% of the world's population has not got coronavirus. No. They want to tell you that, coronavirus is up by whatever, and it's gone from a few thousand to a few more thousand, right? So that's what sells the papers. But the mad thing about eternal human pessimism is that all pessimists have been wrong for the whole of human history, apart from really clever, Jewish doctors who lived in Vienna or Berlin in 1938 and said, I'm taking my family and I'm moving to Canada or London. And everyone went, don't be crazy. There's no way Hitler will do that. And, sometimes at the micro level in history, pessimism is obviously quite very correct, but big picture for the whole of human progress and the whole of human history, we're just getting better and better. Life is even if you're minimum wage today, you have access to more goods and comfort and ease and security and longevity and leisure and travel and sport than a Chinese emperor had 300 years ago, factually. So that might be the scenario.
It's funny because I heard something, I can't quote it because I can't remember exactly what it was, and I'll come back to it about the longevity, which I heard about. Japan had the longest living people, and their government and insurances and their big corporations weren't prepared for the Japanese to live as long as they were living, essentially. So they were actually struggling to make these payments of these long-term pensions, the insurances that people were drawing down on. And I'll touch on that in a moment. But just making a quick shift, going on to the banks, how safe are the banks? I'm not going to dive into that too much, but what I want to touch on, which I do want to understand your thoughts, because I do cost average as well in the stock market, and I know a lot of people are thinking about, do I dive into it now, and what do I do, and blah blah blah. But how manipulated is the stock market? Because I see it this way, and correct me if I'm wrong in any way, but I see gold, physical, tangible. I can buy it, I can hold it. I know that I can trade it. If it ever got to the Book of Eli, I can only trade so many chickens until I need value of gold to say, well, actually, I want something more than your chicken.
Yeah.
The stock market, is it manipulated by perhaps behind the scene coronavirus? Is it perhaps manipulated by the big holders, the Rothschilds and the JP Morgans and the big ones? How real is the stock market? How real is it?
So my genuine belief is, okay, I had an argument with my dad about this a few months ago, where he was like, he owned some shares in some gold company that some mate had told him, and he said to me, and it was being acquired, and he thought it was being acquired for less than he paid, and he was like, it's a stitch up, this is a con, it's a con, it's all the big, it's you lot in the city. And I said, Dad, and I pulled up my Bloomberg screen, I said, there are 649 institutional shareholders of this business based in conservatively 40 cities in the world. Okay. It is completely illegal for any of them under every system, whether they live in London or New York or Singapore or Munich or wherever, for them to collude with another shareholder in anything to do with the company being taken out. So what you're suggesting has happened here is that at least 500 of them have managed to get on a secret conference call across 12 time zones. And, bear in mind, these are all incredibly egotistical, arrogant people who probably think that their way is the best way. And somehow managed to, pull out of the hat that they've controlled the. I mean, it's just absolute bollocks for anybody who understands how the trading of shares works and how institutional investment works, right? Somebody was saying, I had another row on Facebook with some moron a few months ago who's basically saying that Vanguard control the stock market. And I was like, well, mate, you don't even begin to understand how clueless you are by saying that, right? He's like, well, they've got 6 trillion of, yeah, I know. Okay, so number one, 6 trillion is peanuts compared to, I don't know, $200 trillion a day of FX flows or whatever, but it's not peanuts. It's a big number. But more importantly, that totally fails to understand what Vanguard is. Vanguard, 99% of Vanguard's assets are execution only assets, right? There's no one at Vanguard who can go into Vanguard this morning and go, I'm going to take $6 trillion and put it in, BP or Shell and move the price. In fact, the people at Vanguard are just order takers from people like you and me who wake up in the morning and go, I want to buy, 50 grand's worth of the S&P 500 today. And then it gets pumped into Vanguard and gets automatically put into those 500 companies. So
is it essentially too big to be corrupt? Because I think that's there's too many strings. You can't corrupt this huge thing.
And there's the book I'm reading at the moment actually is absolutely fantastic book, The Evolution of Everything, by a guy called Matt Ridley. He also wrote a book called The Rational Optimist, two of my favorite books of all time. This book basically talks about how human experience and the world is characterized by chaos and evolution. It's billions of tiny little incremental evolutions which create systems and cultures and human progress. I mean, there is very, very little control, right? It's all happenstance and haphazard, and the world is characterized by nuance, sophistication, and plurality. Real complexity. There is no global elite that could possibly hope to control the 100,000 listed entities. That having been said, if there is any entity that does influence things, it's the cabal of the Fed and what they do with printing the US dollar.
Right.
And then how all the big investment banks react to that. And that certainly in aggregate, that drives things, but that's just such a huge broad brush. Like in terms of how do you actually manipulate a stock market,
because I was going to say, I think the image that comes to mind is this secret dungeon where people go in these capes, and got the Rothschilds, you've got someone from JP Morgan,
yeah, exactly.
Someone, and then Trump's in the middle, sort of laughing, and stuff like that. So, but it is too big for us to go.
Even if you got, firstly, you want to get the Rothschilds, Trump, the Gulandris family, Jeff Bezos. I mean, the Chinese, what's the premier of China called? Xi Jinping or whatever, Kim Jong-un, or you know, I mean, you want to get for that to work, they'd all have to agree, right? And they'd all have to be meeting in, like you say, it would have to be a dungeon, and somebody's going to get them on their iPhone and go, "Oh, I just saw Kim Jong-un meeting Trump in you know, Switzerland."
Oh,
I mean, it is abject bollocks. With apologies from it's just it now. There are certainly imperfections in the system, and there are areas that, at the smaller level, for sure, there are market participants who will try and manipulate the share price of a 500 million or $1 billion company.
Mm-hmm.
I think that happens less and less because the regulators are unbelievably hardcore, and there's so much red tape. You know, every phone call is recorded, you know, and held for years, and they can literally go, "I'm going to listen to what you were saying to the hedge fund you were talking to on Tuesday, the 7th of October, 2011, pull up the tapes."
Something would be exposed.
Yeah, correct. And I think it's good to have this discussion because I think the only people who can ever make that argument have never had a front office job at an investment bank or hedge fund, you know, and actually understood the market dynamics and the you know, just how the software system. I mean, something like 80% of US stock market turnover now happens between machines. Like high frequency trading machines which are only trading because of an algorithm. Yeah. Now you could argue that maybe there's somebody controlling the algorithm, but then there'll be another 1,000 machines with a different algorithm. So you know, there'd be
too much exposure. I'm glad you've covered that, and I think that's reassuring to hear all of that as well. I want to, obviously we're coming up to time. I'm just going to open it up to, I'm sorry I haven't been able to get through all the questions at the moment. Obviously it's quite a few, but is everyone okay? Andrew, are you okay possibly just for an additional 10 minutes?
Yeah, sure. And I should apologise because the reason we can't get through the 20 whatever questions is because I talk too much and answer questions and go mad and start talking about movies and the apocalypse. So apologies to everyone who's asked a question I haven't answered.
No, I mean, like I said, I could go for hours, to be honest, just listening, Andrew, and taking out all the knowledge from you.
I could, except I've promised my wife to take our kids for a walk in the park pretty soon. So yeah,
I'll be doing something similar shortly. Yeah. Okay, well, I want to touch on, should we be taking note of Warren Buffett's movement, by the way? Should we at least be taking note of that? And what's your quick take on that?
It's specifically into gold.
Well, just what that means as a movement.
Yeah. Well, I think definitely because so that piece I mentioned earlier about one of the 3 gold pieces I wrote, which asset classes averaged 12.3%. I specifically talk about why Buffett was traditionally bearish of gold, and basically that his mentor Ben Graham, his whole professional investment career was against the backdrop of gold being illegal for private individuals to hold. So why would he ever run any models or even think about gold? You couldn't buy it legally. So that informs Buffett's stance on gold. And the other thing about him is that, of course, if you're a billionaire, if you're a multi-billionaire because of the equities you own, of course you don't need to own gold. He could lose 99% of his money and he'd still be a multi-millionaire. Why does he need an inflation hedge?
Yeah.
So Edward de Bono, the Cambridge thinker, talks about logic bubbles. Everyone functions in their own logic bubble. So those 2 really compelling reasons why Buffett's logic bubble about gold was more negative than mine is, right? But, so he can be right and I can be right. But the fact that he's now changed his tune and weighed it in is genuinely very interesting because that's, if anything, it's more powerful than another person who wasn't publicly a massive bear of gold for 50 or 60 years, right?
Yeah. Okay, brilliant. Thanks for that answer. Andrew, I just want to finish on one question because this is something that comes up in conversation a lot, and a conversation that I have quite a lot as well, and something that I'm really keen to hear your thoughts on is in regards to the banking system. I just want to throw a scenario out there. With the banking system and all the QE that's going on, we know what's happening with that. We've got the big picture of where this could go one way or another. Like you say, it's Star Trek or Mad Max. Yeah. In regards to the banking sitting in the middle, obviously, I believe in spreading, and I know a lot of people here do, and it's in your book. I use, I think, about 5, I think even up to 6 banks. I spread my risk as much as I can there. Yeah. However, if everyone on this call was to go to a high street bank and say, right, I've got 100 grand in there, I want to pull out every penny. I don't believe the bank would let you do that.
Well, see Northern Rock for details only 8 years ago or whatever.
Exactly. So what does that mean for the future? Could we ever see, because I had to withdraw something about 4,500 a few months back, and they wanted to know everything about me. And I turned around and I said, I had my paperwork, we done that, but done the formalities, and then it was, what are you using this for? It was questions, and I just said, I don't need to answer these, and I'm not comfortable. And I actually left that bank because the customer service went downhill.
Yeah.
Do you think in the future they could be putting in not regulations but hurdles as such, where you can't actually withdraw your money, and to the average eye, to the average person walking down the road, they just think, oh, it's just another formality that I have to now sign paperwork.
Because 99% of British adults will never withdraw more than like 50 quid at any one time,
and they won't
even notice. Yeah.
So do you think long term, in the next 10, 15, 20 years, or whatever it might be, the banking system actually, if people start becoming financially aware, like we're all doing on this call, but if that was across a larger scale across the UK, and everyone said, actually, bugger this, I'm going to go buy gold and I'm going to start investing in stock, the bank, give me back my money, could they say, actually, no, we don't have your money, and we're not giving it to you?
So that's exactly what happened to Cypriots in Cyprus in the European banking crisis. That basically, if you were with Bank of Cyprus or Popular Bank of Cyprus or whatever, you just turn up one day and you can get money out. It does happen. It can happen. It has happened in Europe in the relatively recent past. What was the other? Oh yeah, and then the other example is so if people, that's exactly why the US government made it illegal for private individuals to own gold in the 30s, right? Because after the 1929 stock market crash, lots of people said, bugger this, I'm going to take my significant money and buy physical gold and have physical gold in a safe in my Manhattan apartment or my Long Island, what's that movie with Robert Redford in the old days? And anyway, I digress. But then, so what I'd say though is, I only have, I have a bit more at the moment because I just got paid for my quarter. But generally, to my point earlier, I only have a year's worth of liquidity in a bank. Everything else is in equities, gold, whatever, other stuff, right? So, and that's spread around various things, right? So I don't have that concentration risk that you're talking about, and you don't need to have, because you're right. The other thing is people will say, there are two things. So the financial services compensation scheme protects you for 85 grand, right? So you could, if you've got more than, every time you have more than 85 grand, all other things being equal, you should open another account. So you get 85, 85, 85, 85, and then the FSCS will pay you out 85. Except in the scenario where that happens, if Northern Rock goes bust, you get your 85 grand back. It'll take a few months of admin and paperwork and whatever else. In a scenario that you're talking about, where there's a fundamental structural ruction and it's Mad Max, right? There's no way the FSCS is going to pay you out your 85 grand. So I think it's kind of pointless, right?
Yeah.
And the other thing to say is, if all of your wealth over and above your 1 year liquidity requirement I just talked about, that I keep in my current account at Lloyd's or whatever, if all of your wealth is then at Hargreaves Lansdown or AJ Bell or Interactive Investor or whichever, Barclays Stockbroker, whichever outfit you're using, I don't care about the 85 grand there either, because when you own an investment fund, for example, using one of those intermediaries, you actually legally own the assets in the investment fund. So if you've got £1 million at Hargreaves Lansdown, strictly if Hargreaves Lansdown go bust, you're covered for 85 grand. Oh no, I'm at risk for nearly $1 million, 900 and whatever grand, 915 grand of the money that isn't covered, except you're not, because the underlying, if you own the S&P 500, you own 500 shares, and the depository and the custodian have a legal obligation to return that money to you. Yeah. So I think I think as long as you are keeping less than a year's worth of cash in a current account at a bank, you don't really need to worry about those things, unless it's the end of the world and it's Mad Max or Book of Eli, in which case you're going to be worrying about.
You're screwed anyway.
Yeah, exactly.
Oh, well, this is, I've absolutely loved every moment of this. I'll probably have to draw it to a close, Andrew, as I know other people will have to get on. But It's been amazing. I'm just going to open this up just so I can see everyone as well. I do apologise, everyone. There were so many questions. We probably would have needed around about 3 hours, I imagine, Andrew, probably to get through all the questions, wouldn't we? So I do apologise if I couldn't get through to all of your questions. Perhaps maybe in the future, Andrew, we could welcome you back perhaps in the future.
Would love to, and all I'd say is as well, please do ping me. My email, my personal email is andrew.craig@plainenglishfinance.com. Or, you know, go on plainenglishfinance.com, chuck your email on the bottom of the homepage, and you'll get my regular emails, which are not a daily bombardment. They're every 2 to 6 weeks because I just haven't got time to write daily bombardments. And, you know, and get in touch. I will. Last time I did one of these calls, I got like 97 emails afterwards, and it took me 2 months to get through them all. So if I don't get back to you, that's the reason. But yeah, please do email me personally if I was not able to answer your question today. And that's with apologies again. That's because I do crap on, as my wife reminds me.
No, it's been brilliant. And you've got, you know, the experiences you've had are what sounds like incredible. And what you've learned is brilliant. And obviously what we can take from that and what we have taken from that on this call is brilliant. Certainly for myself, it's been a long time coming. And I'm so glad that I've got you on, Andrew. And it's been really amazing, especially on a Saturday as well.
Well, you know, thank you very much for organising it, and thanks to everyone for